Good morning, everybody. Welcome to the ARM Report. This is our morning meeting. Thanks for joining me. Starting with the Rosenthal rant. Are you ready for this? You like the suit and tie I got on right now? Does it make me look like I know what I'm talking about more than any other day? Quick reminder. You're watching CNBC. You're watching Bloomberg. You see a bunch of guys in suits and ties. They're telling you what the market's going to do. They're telling you what the economy is going to do. They have no idea what they're talking about. None. Zero. Okay? They're guessing. They're grasping at straws. I just reposted a tweet on my Twitter account at Brett Rosenthal, right? From Paul Krugman, right? Paul Krugman. Everyone loves to trot this guy out, right along with, Nassim Taleb, right? Guys who made a couple of calls at one point, Krugman now has a Nobel Prize, right? But if you look at that tweet, in 1995, Paul Krugman said the internet, by 2005, people would realize the internet had no more of an impact on the world economy than the fax machine. Okay? So that's just a quick reminder when you watch anybody give you predictions about the economy or a trend. They're just grasping at straws like everybody else. Sometimes Paul gets it right. Sometimes he gets it embarrassingly wrong, right? You trot out Nassim Taleb because he called a black swan event once. And every time the market starts to look bad, get that guy on TV. None of these people know any more than everybody else. They've done research. That's good. They've written some research papers. That's great. They got lucky a couple times on a couple of calls. Good for them. At the ARMor Report, we invest by reading and reacting to what we're seeing. You'll hear me talk about sometimes what I think is going to happen. Like Paul Krugman. I'll come up with things that I think might happen, but I always try to back up my comments with the reminder that we get on the right side of probabilities when reward is worth risk. That's it. And we do it three ways, right? There's three essential stages to what we're doing here. Research, like everybody else. We're building a proprietary flow of fundamental information. And we put that information in the language of stocks to invest in on our whiteboard. Then we use the second essential stage to tell us when to put money to work. It's algorithms. That's a proprietary flow of actionable information. Now, it doesn't mean that the algorithms are going to be right every time. They're a probability algorithm, which means they're going to be right X% of the time. Some, who knows where, could be 7 out of 10 times, right? It means 3 times, going to get an entry point, it's going to fail on indexes, right? We'll get to that in a minute, the risk monitor. And then we use stop losses and risk management decisions and rules to protect ourselves, to protect ourselves from our ego, to protect ourselves from fear and greed. Get the emotion out of the equation if we can. It's a never-ending battle. Okay? That's the battle we're in. You and I, we share it together. You know why? Because you're on the virtual hedge fund trading desk. You're one of these people sitting down here, shouting across screens, sharing information all day with me on the live desk. And it's the power of all of us. We're the Davids. We're all getting together and we're taking on the Goliaths of institutions and all the other professional managers, right? We're taking this together as an army and we're going to slay them. So let's jump into how we're going to run money today. And what the risk monitor is telling us, I like to always start with a quick review. So here's a graphic representation of a 60-minute chart of the S&P and the NASDAQ 100 armrAlgos. Okay, you can see a little caret here gives us the risk on entry point in the S&P, and this little caret here tells us that we're no longer long the S&P. Now, the NASDAQ over here, long here, boom, and it's still just barely a hair's breadth above the stop. Okay, so what I want to talk about today, and don't forget, I'm sharing with you how I run my own personal capital. Fill in the rest of that disclaimer statement, however you want it to go. Something to do with make your own decisions, figure out your own risk tolerance, all that stuff. I like to think of myself as the chief investment officer of the virtual hedge fund we're running, and you're the portfolio managers of your own tranche of capital. So you get the idea, the big picture from what I'm doing, what the algos are doing, the interpretation, and then you make your own decisions based on conservative, balanced, or aggressive type approaches. Only you know how to run your own money, so you got to figure that out. So let's just go over the facts of the case, and they are undisputed. Number one, the risk monitor went yellow on Friday. I shared with you that in bear markets, the risk monitor can change to a positive color. It doesn't know that the Fed's raising rates. It doesn't know that the Fed's doing quantitative tightening. It doesn't know all the other factors, right? An algorithm is just about really understanding when there's such an oversold situation and the turn starts to come, it's sifting through the data, trying to say, okay, is there a footprint of institutional? Is the Goliath out there starting to put money to work? If so, we want to be there, okay? So after 2008's bear market, we changed our risk monitor a little bit. 2008 bear market, 2015, you can see it. There's like a 3-month sell-off there. It certainly in 2000, 2001, in big bear markets, the best probability algorithms occasionally are going to tell you there's a window where money might come in. And you don't really know, we don't really know if that's just a short covering rally, if it's just an exhaustion rally, okay? And so we have to look at all of the pieces. And so what we did after 2008, after that experience, we said, okay, when the risk monitor goes positive, right? 6 of the 7 indexes we follow all show us a footprint of possible institutional investing. Once we get into the bear market, we say, okay, if the price chart pattern's not there, if there's tons of overhead above us, and we know that real bull markets and real changes in trend occur off of solid base structure, then what we'll do is we'll say, okay, there could be a tradable rally here, and we're going to change the risk monitor from red to yellow. But we're going to be clear on the fact that there's a lot of risk out there. Conservative portfolios aren't putting any money to work on Friday. They don't care that maybe there's a little tradable window, right? Aggressive portfolios, they're going at it. Obviously, balanced is somewhere in between. So, risk monitor yellow, things are dangerous. Let's give it a shot. Tight stops. Market goes nowhere on Monday and then has what I call a 100% down day yesterday. And it looks kind of like this. I call it 100% because there's absolutely no rally. This is our day trading algo, right? So these are the big indexes on a 3-minute chart. It opens higher and then just sells off almost in a straight line all day. I call it 100% down day when the market stays below this yellow line here. Okay, that's the S&P. You can see over here the NASDAQ does the same thing. Okay, that yellow line is the first standard deviation below the armor VWAP. If the market cannot even rally to the VWAP at any point during the day, that's a 100% down day. It's It's very rare. I would say it's almost non-existent in a bull market for the market never to even test a mean reversion trade during the day. There's usually at least one mean reversion trade during the day where the market rallies up to the VWAP to take a peak. And then it might roll over and break down again, but that's not 100% down day. There was a rally in there. There was a shot in it. Yesterday, just absolute selling all day, like locked in it. Nothing. So the risk monitor, because the S&P got stopped out on that, goes back to red. The risk monitor cannot be any color other than red when the S&P is stopped out of its algo. Now, we use all the other indexes to give us yellows and greens and these types of things. But the biggest index is the S&P. The structure of the index has all types of stocks in the 500 stocks. So you're looking at the whole market there. When it goes out, when a stop gets hit, the risk monitor red. What I want to make sure you understand, though, is that's a very tight stop. The other indexes, so the individual algos for the other indexes, those indexes are still long. If you were just trading the algo of the Qs, you'd still be long. Because it's a hair's breadth. Just a tiny bit above the stop. Another down day today, and they'll all get blown out. But for the sake of the risk monitor, we're already out. So what does that mean? Well, conservative portfolios never put money in. So they're just sitting this whole process out. They're in cash. They're collecting their alpha as the market keeps going lower. Balanced, 100% cash. Aggressive portfolios, 100% cash. What will I do today? Nothing in the conservative, obviously. All right. Balanced, nothing, cash. My aggressive portfolio, I'll use some day trading techniques. I'll go after some charmer ideas, which is amazing, Chad. I'm going to give you a little shout out because you've been putting some great small cap ideas, micro cap ideas into the room, and we hop on these charmer trades. We made money yesterday charmer trading in a day where the market was 100% down day. That's incredible. I mean, I just couldn't believe we were making money on a charmer trade together. And that's yesterday was AGRX. We had two trades on. One lost money real quick. Whoops. And AGRX, made us a lot of money, right? Had a huge run. So yesterday, this was the trade that we really had success on. And it looks just like this. Chad puts it into the room. It makes this consolidation pennant. It breaks above the VWAP and takes out these highs. We get long on that bar. With the low of that bar as the stop, and the thing skyrocketed. We sold some up here. I sold the rest for myself up here, and I just had a raised stop in here. So basically, we grabbed it from here, and we were booking profits somewhere right up in this area. Some a little higher, a little lower, and then the trailed stop trailed out right around there. Okay? And then it sold off, came back up. But that was a great trade. So thanks for that, Chad, and we'll take a look again today to see what you put in the room and see if there's something that sets up. But my focus for my aggressive portfolio will be trading the indexes again. I know there's a question from Steven about spot gamma and shouldn't the market go up into the end of the quarter, OPEX on Friday, all of these things. All I can say is that bull market strategies don't work that well in a bear market. Is it possible there'll be a day in here where the market rips higher because of options activity? Totally possible. I'm looking for the long trade. My favorite thing to do when the market's cratering and I have 100% cash is look to get long and capture the upside. Right? We captured it Thursday and Friday last week. Maybe we'll get a Thursday, Friday rally this week. I don't know. So I'll be out there looking for it. Let's take a look at precious metals. I've just pulled the plug. I had a small position on Sprott physical gold, and I just stepped out. Okay, you don't have to step out. It's still above the uptrend. You could stay with it if you wanted to, but I just decided to go to 100% cash and take a break and see what's going on because the market's not making any sense. And I'm looking at the leadership of the mining stocks. It's just very, again, correlations break down. So I don't know if this is going to work again, but mining stocks usually lead the metal. Okay. And the mining stocks look god awful. Even in 2008, where we made money in 2000, running hedge funds in 2000, I had 3 hedge funds, an offshore fund, a long short macro fund, and a precious metals fund. Okay. And we made money in all of our funds in 2008. And the primary reason is we traded precious metals well. And even that year, the mining stocks were a disaster. It was the metal itself that made money, but even the metal itself, there were difficult periods in 2008. So you had to carry a lot of cash, and then you had to pick your moments. And by the end of the year, we were making some money. So in my experience, when the mining stocks are just breaking down, the metal is just not going anywhere. Now, this could be different. It could be different. But for now, I'm just stepping out, and I'm saying what I said to you on, GDX and all my other gold positions. I need gold. I'm just looking at GLD as another example. I need gold to close above the downward trending 50 and 200-day moving averages. Okay. So if it has a day where it closes above there, I'll put money back to work in metals, and I'll use the low of that day as my stop again. And until then, I'm just going to carry cash instead of gold. It's just not acting like the hedge it should act like. This morning it's up a little bit. That's great. We'll see if it can have a rally. I'm looking towards energy. There's the bounce off the 200-day, and I'm looking for the double bottom action or the bottoming action of some kind for me to get long energy again. I think energy makes a lot of sense, but I don't think I think that this market has the Fed has outlawed V bottoms. V bottoms almost never work anyway. But then unreal, massive quantitative easing after the pandemic made a lot of people think that V bottoms work all the time because they just kept working. They don't. That's just an environment where the Fed was adding so much liquidity, nobody could wait. Nobody could wait for a bottom. There's any sell-off they'd buy. We're back to reality now. There's Fed quantitative tightening. And the last thing I'll be doing in a market like this is buying headlines about G7 decisions about anything, right? So market energy pops up on that. That's great. I'm looking for it to build a structure. It doesn't have to go back down to the 200-day moving average. It could go up here, build a base, boom. I'll be happy to put money to work over the next couple of weeks. I just won't put it to work right now in energy. And I just wanted to kind of end on this note. The risk monitor could go green in the next couple of trading sessions or the next week or two. It's totally possible. You get a bottom. Sometimes you get a rip off the bottom, and then this 100% down day, a disaster. It goes down again, tests the low, makes a double bottom, and reverses up again. Then we might have structure. I'll put money back to work. So it's a read and react market. Right now, what I'm reading and reacting to is a market that looks awful, and it looks like it's going lower. All right, so I'm going to just protect capital. But I'm never going to Nassim Taleb it. I'm not going to come out here and as much as I love Hugh Hendry, I'm not going to come out here like Hugh Hendry and talk about the end of days and how everything's going to implode. Like, in all due respect to Hugh, and I love him, he's been wrong a lot, and he'll admit it. He'll admit it, right? So we're all just doing our best to figure out direction. What we do here is we create a flow of proprietary fundamental information, and we act on it when the proprietary technical information of algorithms that we've built tells us we have a window, and then we wrap it up with risk management rules because we know we have clay feet. That's just the way it is. All right. So with that, I'll leave you today. We'll go fire up the engines for the live trading desk. I'm going to be high grading my trades. It's going to have to be a great entry point. If I see it, I'll put some money to work. Otherwise, carry cash, do research, get myself ready for the next risk monitor change. That's what I'll be doing. Any questions before I go? Nice tie. Thank you very much, man. I used to dress like this every day for like 20 years. Oh my God, guys. Ugh. I don't know how I did it. I mean, you just can't breathe. Whose idea was this to constrict blood vessels so the brain, so blood flow to the brain is not at its maximum? I don't get it. I don't get it. But I thought I'd put it on a little bit to say hello today and make a point. I'm much more of a hoodie t-shirt kind of guy where I'm running money and I can think clearly because I get all the blood in my head. Commodities in general in a crash. Yeah, pricing in deflation. Yeah, I don't know what's going on there, Brian. Commodities are imploding, and I don't know what's going on. So energy's still holding up a little bit, natural gas holding up a little bit. Other commodities are imploding. I don't know. I guess what I'm saying is yes, at face value, it looks like they're pricing in deflation. But a part of me wonders if it was just a crowded hedge fund trade and weird things happen when the market implodes. There's hedge funds blowing up. I mean, I guarantee that, right? And we'll find that out. These are like lurching disasters. You know, Melvin Capital was the last one. And, you know, there's somebody else is blowing up. And if they have a portfolio full of commodities, which they should, because there's inflation and it's only going to get worse, but they're dumping all of their commodities because they have to raise cash and return capital to investors. You know what I'm saying, Brian? You've been in this long enough to know what I'm talking about. All kinds of weird things happen. When long-term capital management was imploding in 1998, all kinds of things are getting sold that didn't make any sense. And then you found out why. It's because that's what was in their book, and it was the only thing liquid. So they dumped it to try to make up for what they were losing over here. So I would caution anybody from assuming that the action in commodities is pricing in deflation right now. I'm not sure that's happening. I think what's happening is financial markets aren't functioning correctly. And I have no doubt there's blowups that will be revealed over time. That's what's happened in the past, and I imagine it's happening now. All right, I appreciate your time with me. I'll see you guys on the live desk. The next 15 minutes, we'll fire that up, and we'll get to work again. Thanks for joining me this morning and giving me your time. Take care, everybody.